chapter 3, we introduce another really important topic, and one that we won't fully understand at this juncture. In chapter 22, we'll get into the real depths of the income tax system in the United States. But what I want to do here in chapter 3 is merely introduce the concept to you so that when we talk about things like 401ks and IRAs and HSAs, you understand the tax savings that are generated through those types of tax shelters. So in chapter 3, we're going to talk about 4 types of taxes that we are typically going to pay on the money that we earn. The most important of those will be the federal income taxes. So that's U.S. governmental income tax. I'm assuming you live in the United States and work in the United States. If you work here, you will be paying into the U.S. federal income tax system. It's the most complicated tax system that we face. It's also almost always the one that levies the most tax revenue from us. Therefore, it's the one we need to understand the best and the one that will probably influence our decision making most often. Depending on where you live, you might also have a state income tax system. In states like California, the taxes can be really high. So I think the maximum tax that they face there is about 13%, which is really significant, enough to influence a lot of your decision making. If you live in a state like Tennessee or Texas or Florida, they don't have any state income taxes at all, and that certainly makes things easy, both from a tax-paying standpoint and also a tax planning standpoint. I live in Georgia, and for us, our taxes are maxed out at, I think, 5.5% is the highest tax rate we can face. So I'm not going to spend a lot of time on state income taxes because I don't know what state you're in, and also because the tax rates here are relatively small, so it's okay to not understand them as well because it's unlikely they'll be influencing a lot of your decision making. And then the third and the fourth taxes that you're very likely to face, not guaranteed to face, but very likely to face, are Social Security and Medicare taxes. We will go into much greater detail on both of these systems in the future, but for now what I can say is these systems are simple, and for most people who work for a business that aren't self-employed, you simply pay a flat 6.2% tax for Social Security and a flat 1.45% tax for Medicare. Again, I'm simplifying here a little bit, but for most people that is indeed the case. So if you earn $100,000 in income, you're going to pay $6,200 in Social Security, and you're going to pay $1,450 in Medicare taxes. So not very complicated. But this federal income tax system is. And that's why it's going to garner most of our attention. So here at the bottom of the page, I'm going to add in the tax brackets for a single individual in the United States in 2024. So this is 2024. If you're watching this in the future, maybe I haven't updated it, but if you go to my website, freefinancebook.com, it will include all the tax tables that you need there in the text of chapter 3. Okay, so I'm including those tax brackets now, and before I show you the correct way to solve for this, let me show you the wrong way to solve for this. So let's assume that someone's income is $50,000 and they are single. Single is simple. It just means they're not married, they don't have any dependents. That's how most recent college graduates would be categorized. With an income of $50,000, a very common mistake that students will make early on in their learning process is they will simply apply 22% to that entire $50,000 in income. They look at the tax brackets, they see that 22% label, and they say, okay, well, with $50,000 in income, you'd have 22% tax rate, and that would be how much you have to pay. That is totally wrong, okay? And it's wrong for a good reason. If this is the way the tax system worked, you'd end up with some really strange incentives. Like if your income just got pushed over into the 22% bracket and all of your money got taxed at 22%, then you would end up with less net income. In other words, if your income went up into the 22% bracket, you could pay so much more in taxes that you would lose out on earnings after you consider taxes being paid. Thankfully, that's not how our system works. So the type of system we use in the United States and most countries employ is called a marginal tax system. That means that every dollar is treated uniquely. It's treated on its own. And the beauty of a marginal tax system is that if you are offered a raise, you should always take it. Don't be like one of my family members who was in a situation where her income went up and she actually marched into her office, to her boss's office, and said, I don't want the raise because it'll put me in the higher tax bracket. And the boss was like, okay, I won't give you the raise. Always take the raise. The marginal tax system guarantees that if your income goes up, your net income goes up. Okay? So let me show you the right way to do this. In a marginal tax system, you have to treat every dollar as unique. So it's like the first dollar you earn, the very beginning of the year, that very first dollar you earn, that's going to be taxed at a 10% rate. The second dollar will be taxed at a 10% rate. And you'll just keep counting them up until your extra dollars fall into another category. So if you earn $50,000, the first $11,600 that you own, or that you earn rather, will be taxed at 10%. Okay? Everybody, doesn't matter if we're talking about me or Elon Musk, the first $11,600 we earn is taxed at 10%. It's the additional dollars that get taxed at a higher rate. So if you earn $50,000, you'll fill up that bottom bracket, and you'll fill up that next bracket too. The next bracket goes from $47,150 to $11,600. Running out of room here a little bit, but all of that would be taxed at 12%. So you fill up the bottom bracket, you fill up the second bracket, and then that just leaves a little bit of money left over to go into that third bracket. You earn $50,000 in income, so that leaves us with, what is that, $2,850 that needs to be taxed at the 22% bracket. So that would be how you set this up, and this is how you're going to do it every single time in this class, and also when you do this in your real life. Now, a lot of times people use tax planning software. It does this on its own, but it's still important for you to understand what's going on under the hood here when we're thinking about these tax systems. If you don't understand taxes, you're not going to understand how to take advantage of the loopholes that are available to you from a tax planning standpoint, like 401ks. Okay? So what you should get here for their total taxes would be $6,053. Now, as we'll learn in this class, there's a lot you can do with tax planning. What this person might recognize is, look, they've got $2,850 getting taxed at a 22% rate. Maybe they'd like to try to avoid that. And so what they could do is they could contribute $2,850 to something called a traditional 401k. And in doing so, that would actually push their taxable income down to $47,150. And this, again, just goes to show why it's important to understand how the tax system works. If you know how it works, you know how to take advantage of it, okay? We're going to learn a lot more about 401ks and intricacies about the tax system later on in this class, but I'm just trying to give you a taste because it's really hard to talk about any concepts in personal finance without having at least some grasp on how the tax system works. So that's what it would look like if you're single. Just to give you another example, let's say that you are married. Now there's 4 typical ways people can file their taxes. They can file single, which is what we just did. They can file married filing jointly, which is the second most common. So that basically means you get married and you and your spouse combine your income into one tax calculation. You can do married filing separately, which is pretty unusual, but there are examples of when it would happen. Read it in my book to find more. And then the fourth possibility that's common is head of household. And that would be like a single parent or somebody who's taking care of like their elderly parents or something like that. Okay. So by far the most common are single and married filing jointly. So let me pop up the married filing jointly tax code down here now, and we'll go through another example. So let's say that somebody who is married filing jointly has $187,000 in total income. That would be them and their spouse combined, right? This is now putting it all together into one unit. What you would do with that $187,000 is follow along with the brackets just like we did in the last example. The first $23,200 would be taxed at 10%. The next chunk be taxed at 12%. And then just like in the last example, we get up to the 22% threshold here, which is pretty common. For a college graduate who has a little bit of experience, it's typical to get up to the 22% tax bracket for federal income taxes. And so what we should get after we solve for all of this, and hopefully you're following along with me here, and this is making sense, $31,246 in taxes, okay? So that's an example of married filing jointly. The way the math works is exactly the same, okay? Now you might be wondering, you know, is it better to be married or is it better to be single from a tax planning standpoint? There isn't a lot of difference most of the time, but usually if there's going to be a difference, it's better to be married. And I do actually have a friend who chose to get married a couple years early just to take advantage of a reduction in taxes that came along with that. There are also rare circumstances where it's worse to get married, but most of the time the differences there are pretty small, okay? So before we move on here, I want to do one last example here at the end, but before we do that, let me just make a couple of notes because I'm just going over this in really quick detail. There are things in the book that I want to make sure that you recognize and emphasize as you're reading. First of all, recognize that I'm oversimplifying here. So I'm putting these videos on YouTube. I'm always afraid somebody's going to complain about the content in it and say like, oh, what about all these things you didn't discuss? Yeah, we're going to talk about the complex stuff later on. I'm just trying to get you to the point where you've got some understanding of what's happening here. So we're not talking about deductions. We're not talking about tax credits. We're not talking about any of that stuff now. That happens way in the future, I think in chapter 22. Okay, so there's a lot here that we need to discuss that we're just not ready for. Second note is taking control. I just want to again emphasize that what we're discussing now is really, in my eyes, the true low-hanging fruit. If you can understand the basics of the tax system, you can take advantage of it in a way that can save you tens or hundreds of thousands of dollars in the future. There's a lot of pain that often comes with financial planning. When people think financial planning, what they think is not spending money, trying to save as much as possible, really making your current life worse. That's not always the case. A lot of times, personal finance is all about just taking the dollars you're already saving and saving them in a way that's efficient as possible. And we're going to gain some efficiency if we can think about the tax status of our income and other earnings that we generate from like stocks and things like that. Okay? A third thing I want you to make note of is that rules change yearly. Every year, the tax code changes. Sometimes it changes a lot. Sometimes it changes a little bit. A couple years ago, we had sweeping changes in the tax code. I had to really rewrite a lot of my notes. So if you go back to my videos I recorded in the past, a lot of that content is simply outdated. If nothing else, every year the tax code is changed just so those brackets are adjusted. Largely just due to inflation, they adjust those brackets a little bit. But there can be major changes when there's a presidential change, when there's something that happens like COVID that led to a lot of adjustments. So all I'm saying is be prepared to have to relearn this material. If you feel like you're getting a good grip on it now, recognize that you're just going to have to come back here in the future and learn it again because things do change. And then fourth, I want to make a quick note on timing. What I'm going over in this class is the 2024 income tax system. But you will likely not be fully realizing that tax code until 2025. Here's the way this works. If you're a normal employee, you will pay taxes as you earn. So if you're an employee for a business, the HR department and other people that are employed to basically keep an eye on all the employees and make sure that everything is going smoothly will withhold some of your income. They'll take some of your income and say, here's the money that we think you need to pay in taxes. And you can actually go in and change that. You can go to your HR office and say, I think I'd like to withhold a little bit more, a little bit less. There is some flexibility there. But most of the time, it's not worth it. Most of the time, you're just going to let them go with whatever they're doing, and they do a pretty good job of estimating it. So during the year, you'll be paying your taxes. You'll be paying your federal, your state, your Social Security, and your Medicare taxes will automatically be withheld. But at the end of the year, you probably paid too much or you paid too little. And so then you'll have to file your return. So if you've heard of people filing their return or if you've heard references to tax day, by April 15th of the following year, that's tax day, you have to pay your taxes. Okay? And so what that means is maybe you paid $9,000 in income taxes throughout the year just from normal withholding from your income. But in reality, you should have paid, what you owed was $8,000. In this case, you overpaid by $1,000 and you're going to get a tax refund. Now, everybody gets all excited about tax refunds, but all a tax refund is you overpaid taxes and now they're just paying you back. It's like you gave the government an interest-free loan. You just gave them $1,000 and now they're giving it back to you. So you really shouldn't get too excited about a tax refund. Or alternatively, maybe you owed $10,000 in taxes and you paid $9,000. Well, you underpaid. This means you're going to owe the government an extra $1,000. For relatively small amounts like that, it's no problem. But if you owe a lot more than you've paid, there can be penalties on the taxes that you're assessed when you go to file for the following year. Okay, so you can kind of think of, again, as taxes as being two periods. They're the periods that you pay as you earn, and then there's the period where you file. To be clear, this is for income taxes, state and federal income taxes. Your Social Security and Medicare taxes should have been withheld correctly, and there should be no adjustments there to worry about. Before I get you out of here, let's do one final example just to make sure that we understand this. Let's try to put all this together here to make sure we understand. I'm going to put up the single individual taxes again, federal income taxes for somebody who is single. And let's imagine a pretty typical scenario for a college graduate, somebody who is single with an income of $70,000. You know, this is maybe your second or third year out of college. This is what you could expect to earn, perhaps. Okay? Let's say that this person lives in Florida. A lot of my examples will have that stipulation just to make things easy. Okay? Florida has no state income taxes, so let's assume there's no state income tax. Keep things simple. That means you are responsible, though, for paying federal income taxes, and when you run it through the brackets, what you should get is $10,453. If you don't get that, work back through it. Make sure that you can replicate that answer. For Social Security, remember the rate is 6.2%. You should memorize that, and you probably will memorize it automatically if you're taking my class because you're going to see it so many times. So Social Security taxes, that would be $4,340. Remember, this will be automatically withheld from your paycheck. You don't really have to think about it, but it's happening. This will be withheld from your paycheck, but when you get to the end of the year, you're going to have to go back and figure out if you overpaid or underpaid. Either get a return or maybe owe a little bit more to the government. And then Medicare, also a flat rate. 1.45%, and so your Medicare taxes would be $1,015. Again, we've got control here. There are things that we can do. If this person wanted their federal income taxes to go down, they could contribute to a 401k or a traditional IRA. If they wanted all these taxes to go down, they might be able to put put money into something called an HSA, a health savings account. These are all things that we're not prepared to discuss just yet, but it will explain why it's important to know this content. If you understand how the tax system works, you can take advantage of the loopholes that are provided to you. So that's a good introduction. It doesn't cover everything that you need, though. Go to my website, freefinancebook.com. It's a totally free, open access textbook for personal finance. It's got really everything you need to get started on your financial journey. Check it out, freefinancebook.com. You will see practice problems. You will see descriptions, everything you need to learn.